Good evening and welcome back to another video for ApexVol. Today we're going to go through the dashboard and the four main tabs within the dashboard. So we can see here I'm in this dashboard tab. Let me just minimize the window so we can see the full page. So we have the dashboard open. You can see I have Tesla loaded with the stock is currently at 363.58. The market cap is 1.36 trillion. We show the sector, we show the 1 year beta and the 30-day implied move as a dollar amount and as a percentage amount. We'll come on to these expiration tabs in a second, but firstly the volatility tab. At the top here we have a generic non-term structure historical vol trend. So this shows the 30-day implied vol versus the 30-day historical vol. So you have a quick snapshot of where vol is at the minute. Is it overpriced, fairly priced, underpriced, etc. We can see here at the middle left, we have the historical returns distribution. Now this shows 4 key points. So we have the average move, which is showing as 1.86%, the implied move of 1.9%, the assessment, which is showing as fair because implied is similar to the average, and then we show the percentage of time it fell within the implied move. Now to stress, this is term specific. So you can see at the top here, we are in April 15th, so 1 day to go. If I push this out to May 15th, which is the 30-day to go, you can see these have changed. So the average move has gone from, I think it was 1.5% or 1.6% to 7.8%. The implied is 10.7. The assessment is now expensive because implied is just under 3 percentage points higher than the average move, and the within implied is 75%. This within implied is a measure of historical term vol. So if last week's expiration was showing us 6% with 4 days to go, as an example, and that's the historical vol, it only moved 3%. That is within the implied move. So it gives another variation on implied moves. We can see within this here, we have the exceeded downside. So how often the downside expected move was exceeded, how often it stayed within the range, and how often the upside was exceeded. So we can see over the past 100 days, Tesla exceeded the upside implied move 5% of the time. Now, this is term specific and also look back specific. So if I want to see that over, let's say 500 days, we can click within that and we can see the assessment has changed. The assessment has changed because the look back period that we're looking at has got a lot larger. So we 5x'd the look back period. So we go back to when Tesla was much more volatile from day 101 back to day 500. So we can see the average move is 17.35%. And the average move, this is the average move within the term. So the rolling 31-day term structure window average move is 17.3%. Current implied is 10.7. Assessment is cheap. If we want to look back at more recent vol, we can say, let's go 70 days. And we can see vol is expensive over the past 70 days. There are fewer occasions that we measure because obviously the look back period is smaller. So the frequency of moves is less. Therefore, you get less of a bell curve distribution and you get more of a term vol specific distribution. We can see on the right of that, we have a generic volatility smile. You can amend the amount of strikes that you want to see within that. So if you want to see 20 strikes, you can see that, and you can see the IV across the vol smile there. Underneath, we have some generic IV rank versus the 1 month and the 1 year, and we also show versus the SPY and also versus Tesla's sector as well. So if you are trading, excuse me, if you're trading correlation dispersion, you may buy Tesla vol versus the sector as the IV rank is at 12%, as an example. We then show IV versus realized, so the 30-day IV versus the realized IV, 60-day and 90-day. And then we show skew and sentiment here. So we show what percentile the skew is in. That's the put call skew, the put call vol ratio. We show a forecasted vol, which we derive as from a machine learning method. So we input all of the volatility metrics into a machine learning model, and it spits out what the term structure volatility should be. We then have the IV versus the forecast. So at the minute we're plus 5.1 percentage points above that. And you can see that because the implied move is greater than the average. And then we show the call open interest and the put open interest there. And then within this here, so we have 4 tabs. We have volatility, option chain, price chart, and IV surface matrix. Let's dig into the price chart. So this is just a generic view of price. We overlay the earnings within that. So at the bottom here, you can see there's an earnings tab, and you can see what the post earnings move was. So if you want to trade around earnings, you can come back to this tab and you can kind of see what the previous earnings moves were. You can stretch that across 2 years, and you can show that at daily level if you want. You can show it at weekly level. If you want it to be a line chart, you can. Or if you want to just see the percentage return across the given time frame, you can also see that as well. Within the IV surface matrix, this shows the bid and ask pricing, so the mid price of the option at different points across the curve. So for example, you can see the at the money calls and puts are trading at 281 and 411. So this is the one that's the closest to the money. So you can see the 15 delta call and puts are trading at 74 cents, 80 cents. If we go 1 DTE out, we can see that's 117, 120. And if we go all the way to the 24th expiration out, we can see that's 335, 359. We can split this by bid ask. We can go and see it at theta level, or we can also see the Vega as well. We can also change the deltas at the top here to show as a percentage from at the money. So if you want to see the mid prices, you can see that the 10% strangle 10 expirations out is 260, 230, and you can kind of see how that is affected across the curve. So lastly, we have this option chain tab here. So this is also term specific. So if you change this to April 24th, 10 days to go, the option chain will update. So let's keep with May 15th for now. Within the option chain, we give the mid price, we give the Greeks, so delta, gamma, theta, and vega. We give the annualized IV. We also calculate a term structure IV. So the term structure IV is the current premium within the out of the money option, plus the room from the strike to the stock, the out of the money strike to the strike that you're looking at. So for example, the 340, we would calculate the difference between 360, 358 to get to 340 minus the $1.42 move from 365 to 360, 358 plus the premium gives us the implied move for that term, which for 340 is 9.05%. We then calculate open interest and the moneyness. So you can use the moneyness to kind of say, let's look here. The implied move is 10.7%. Let's go to the option chain. I want to be that far away out. You can see the highlighted options are the expected move. And then when we get to this kind of duller option here, that's where you're out of the expected move. So if you want to be outside the expected move in Tesla with a month to go, you may want to trade the 320 and the, where are we? The 410 strangle as an example. So let's go ahead and pretend that we want to do that. We would then want to understand, does that make sense for us? And what are our break-even points? So if we want to load a strategy in here, we can click the mid. So 1 click buys it, 2 click is a sell, and you can click a 3rd time to remove that leg. So let's sell the 320, and then let's go to the 410, and we will sell that as well. So we've got the strangle loaded up here. Once you do click on a strike, you get the strategy builder here. So this shows us the action that we've taken. So we've sold a put and a call. We've sold the put at 320 and we sold the call at 410. The expiration that we've done that within, how many we've sold, the entry price of the strike, and then the delta, which for this is fairly delta neutral, five deltas to the upside, and it shows us the credit that we would receive for that there, alongside theta for the day, so 46 cents a day, plus the Vega there as well. Now, we can play around with this section here. So if we want to push out from the 320 to the 315, we can see these delta values update, the theta values update, etc. We can also see within the option chain here that this also pushes out. So if we go to 310, 305, 300, it kind of follows us up from there. So let's stick to the 320. We can also go an expiration out. So if I want to push that 320 out an expiration, I can click the expiry plus button here. You can see that's gone duller there. This expiration here is still within this, still visible, and this has the dotted line around it. If we then go to that the next expiration out, May 22nd, we see the exact opposite, because this is the expiration that we're now in for this leg, and then this will go dotted here. So if you are trading a calendar spread, you will know where the legs are of the other positions, because it will be a dotted line, which means that you're not, that strike is not within the expiration that you're looking at the minute. So let's put this back to May 15th. You can see they're both going to show dotted now. So let's just flick back to that expiration there. Cool. So we've got the 320, 410 strangle in place. We can see the P&L at expiration here. So we show what the stock price might do. So this is the implied move here. So we're going to go from the current price here to kind of go to 410 and around 326-ish. And we can see where our break-evens are. Because we're slightly outside of the expected move, our break-evens are wider. So the break-even is 310 and 420. That's calculated, obviously, the credit received of $10 here, well, $9.96, plus 410 gets us to 419.96, call it 420, and the 320 minus the 996 takes us to 310. So we round that to the nearest dollar, just to make it simpler. We can see this here, max profit there, the max loss, obviously we've sold the strangle, so it's unlimited. The break-evens is the exact amount, and the percentage chance of profit that we will fall within this strangle width. We then show the Greek values over time, given the days to expiration. So if you were to choose a 10-day to expiration trade, this will obviously say 10 days to expiration. We can see how theta drops off from day 14, it gets more prominent to expiration, and so on and so forth. And we see the price probability distribution. So this shows the previous one standard deviation move, where that has landed historically. So you can kind of plot if you're trading standard deviation from the move, are you within that 68.2% wide bracket? We then have this very generic what if scenario here. So it's where we can shift IV down 20% and up 20%. So if we shift IV up, what does it look like? So we can see here beneath this, the move at the bottom, the line at the bottom here has changed slightly. So if you change the IV, you can see how your P&L will obviously change as days go on. This is the start of the strategy builder, and we can also send this to a full simulator. So if you want to do that, you click within full simulator. And then within this here, you can see your legs have preloaded and pre-populated there and there. And then what you can do then is you can better simulate what it is you want to do. We'll go through this in more detail in a separate video, but essentially you can reduce your days to expiration down, and you can see how the P&L change and that theta takes effect as you click the days to expiration. You can also adjust the IV. So you can say if you had this strangle on and it was 10 days to go and the IV increased for whatever reason, what does that look like? But we'll go into this in much more detail in a future video. But yes, just to kind of go over the dashboard to conclude. In conclusion, it's a term-specific dashboard that helps you measure implied vol versus historical realized over a given look-back period, and you can build positions, and you can understand where your break-even points are. You can understand your Greeks and analyze where the risk is within your position. And as I say, the next video to this will be the what if simulator. So we'll load that strangle again, or we'll load a similar strangle, and we'll go through the what if scenarios with that. And yeah, thank you for listening.